Everyone's cheering this market rally like it's 2020 again. But I hate to be one that's waving the caution flag, but there's something off about this bounce, and it's not just a hunch. The charts, the timing, the signals, they're all hinting at something bigger under the surface. Yeah, it looked great, but honestly, it was just a technical bounce, not driven by earnings or some magical economic news. It was more like the market stretching its legs and saying, all right, time to fill that hole we left behind after Liberation Day. That's called a gap fill, and it's super common in trading. But here's where it gets interesting, or a little concerning. The rally stalled right near something called the Fibonacci 61.8% retracement level. I know, sounds like a mouthful, but stay with me. Fibonacci numbers are everywhere in nature, from the spiral of a seashell to the way trees branch out. It's this pattern where things grow and balance. Traders apply that same math to markets, and one key level they watch is 61.8%. It often acts like a natural resistance point, where a bounce runs out of steam. And, that's kind of where the market paused. Also, and the NASDAQ, or the Qs, are bumping up against their 200-day moving averages. Think of that like a long-term temperature check. When prices hit that line and stall or reverse, it can mean the party's over, at least for now. Now let's talk jobs. People are celebrating the strong jobs report, but that's not necessarily great news. Why? Because it makes it less likely the Fed will cut rates this month, and Trump's been pushing hard for that. And here's the thing people forget. Jobs data lags. Like when companies hit hard times, they don't lay people off right away. First, they slash budgets, cancel raises, put hiring on hold, cut perks. Layoffs come last. So just because the jobs report looks strong now doesn't mean we're not sliding into something rough underneath. Oh, and about those jobs numbers, the last 3 months were all quietly revised downward after the fact. So what are we even looking at? Now here's the real warning sign. Japan, normally quiet, like really quiet, they made a rare move on Friday. They said they're open to selling off U.S. Treasuries. And since they're the biggest foreign holder of our debt, that's not just some side comment. That's a potential earthquake. If Japan starts dumping bonds, yields spike, bond prices fall, and suddenly, everything gets more expensive. Mortgages, car loans, credit cards, stocks start slipping, liquidity dries up, and the economy can spiral fast. The Fed might want to step in, but they'd have to print more money or cut rates again, and honestly, that risks inflation or a loss of global trust in the dollar. So yeah, they're kind of stuck. So while the charts look green, I'd be cautious. Technicals are telling one story. Fundamentals? They're whispering a very different one. So don't get hypnotized by the green. Keep an eye on bonds, watch the technicals, and ask yourself, are we climbing a wall of worry? Or are we walking off a ledge in disguise?